the U.S. economy is standing on the edge of a knife, teetering between unsustainable exuberance and the brutal reality of economic gravity. Both Democrat and Republicans, drunk on political hubris and blinded by ideological extremism, have pushed the U.S. nation into a precarious position. Democrats boast about job creation, while fueling an unprecedented government debt bubble, and Republicans champion protectionism under the guise of national security, setting the stage for devastating economic retaliation. The recklessness of both sides has transformed the economy into a ticking time bomb, and when it detonates, neither party will be spared the blame. Markets are soaring, and the average American is still riding high on government-fueled spending and artificially inflated stock gains. But the underlying structure is rotting. Inflation may have eased, but consumer savings are evaporating, and wages lag behind the cost of living. Wall Street cheers while Main Street struggles. A perfect storm of rising debt, reckless monetary policy, and a refusal by policymakers to acknowledge the harsh truths of economic sustainability. This is a fantasy world propped up by printed money and blind optimism, and when reality hits, it will hit hard. China and the EU, far from being passive observers, have been quietly reshaping the global trade order while Washington drowns in its own political dysfunction. The U.S. government, addicted to imposing tariffs as a band-aid solution, underestimates the long-term retaliation that is brewing. Beijing has been ramping up AI and semiconductor development, cutting its reliance on Western tech, while Brussels has been strengthening economic ties with Asia, solidifying alternative trade routes that could leave the U.S. isolated. The days of American economic dominance are numbered, and those in power are too arrogant or too ignorant to see it. As the storm gathers, both Democrats and Republicans continue to fiddle while Rome burns, leaving Americans to pay the price when the bubble bursts. No one is prepared for the scale of economic upheaval that looms ahead, and as the dominoes begin to fall, there will be nowhere to hide. The question is not if, but when the reckoning arrives. Stay with us till the end. Hello and welcome back to Innovative Check YouTube channel, where we delve into the innovative and transformative projects changing our world. If you're new to the channel and enjoy learning about innovation stories around the world, you've come to the right place. Please subscribe, like, and comment to help boost our videos on YouTube. From this side of the Atlantic, the U.S. economic situation appears to be one of unparalleled resilience. Stock markets are defying gravity, investor confidence is soaring, and real GDP has surged, standing 12% above pre-pandemic levels, after a 2.8% periods of robust economic expansion must inevitably end in collapse. But an examination of underlying economic indicators reveals mounting concerns. In 2024, U.S. federal government borrowing nearly reached 7% of GDP, while the unemployment rate remained steady at approximately 4%. Historically, such an extreme divergence between government borrowing and employment levels has never been recorded in the post-World War II era. This anomaly suggests that the economy is being artificially inflated by excessive deficit spending, pushing domestic consumption higher and further fueling a stock market bubble dominated by tech giants such as Apple, Tesla, and Nvidia. U.S. market capitalization, which stood at 150% of GDP in 2019, has now soared to 210%. An unprecedented leap in such a short span, this rapid expansion in household net worth has driven American consumers to spend nearly every dollar they earn. The national savings rate, which averaged 6.1% between 2010 and 2019, fell from 5.5% to 3.8% in 2024, further amplifying economic vulnerability. Between late 2019 and the end of 2024, personal consumption increased by 15%, government spending rose by 9%, and intellectual property investment surged by a staggering 38%, yet exports of goods and services expanded by only 6%. Housing investment barely reached a 3% increase, and industrial production languished. In sectors experiencing sluggish growth, the U.S. economy mirrors the struggles of the EU, an alarming indication of underlying structural weaknesses. Just a quick reminder to hit the like button below. YouTube has been restricting my videos a lot recently because of bots, so your like does help out this video massively in terms of the algorithm in YouTube. At its core, the U.S. economic boom appears to be a classic debt-fueled expansion, where escalating government deficits, booming stock prices, and consumer spending reinforce each other in a self-perpetuating cycle. The sustainability of this cycle is contingent upon the continued willingness of markets to finance government borrowing at low interest rates. Should confidence wane, a cascade of negative consequences could unfold, abruptly shifting the trajectory from growth to contraction. Despite these red flags, investor exuberance and business optimism remain unshaken. The prevailing sentiment dismisses concerns of an impending downturn, but history has shown that markets rarely anticipate the moment when sentiment shifts. The sudden onset of a crisis often catches even the most seasoned economists off guard, and the warning signals currently flashing across various economic indicators suggest a scenario where confidence could be shattered overnight. Into this precarious landscape steps Donald Trump, whose trade war policies in his first term left an indelible mark on the global economic order. Financial analysts who believe that a renewed wave of tariffs would mirror the events of 2018 misunderstand the starkly different environment of 2025. Back then, the U.S. could afford a prolonged trade war, as could the EU and China. Inflation was low, the federal deficit was below 4% of GDP, and interest rates remained historically low. The broader global economy was relatively stable, with Brussels rallying behind a unified European vision post-Brexit, Russian gas still flowing cheaply, and China enjoying its final phase of rapid economic expansion. If you are enjoying this video so far, please don't forget to subscribe, share the video, and comment. The tariff escalations of 2018-2020 only abated when the pandemic shifted governmental focus. Now, in 2025, the geopolitical and economic landscape has fundamentally changed. Across the EU, stagnant growth, high energy costs, and weakened global demand have eroded stability, leading to widespread political discontent. Eurozone exports and manufacturing output have plummeted, exacerbating economic distress. In China, consumer sentiment remains bleak as the once dominant real estate sector falters, while government measures to stimulate lending and cut borrowing costs have yielded disappointing results. Meanwhile, unlike in 2018, when government debt markets were lulled into complacency by years of central bank intervention, today's bondholders are jittery and acutely aware of the inflationary and growth risks associated with trade conflicts. The volatility in bond markets at the start of the year signaled that a renewed trade war could have far-reaching consequences. In a worst-case scenario, escalating tariffs could reignite U.S. inflation, compelling the Federal Reserve to hike interest rates once more. This would threaten the current stock market bubble, forcing a rapid correction that could erase trillions in household wealth. Should this happen, policymakers might feel compelled to curtail government spending to stabilize markets, an approach that could stifle economic momentum, erode consumer confidence, and usher in the very recession that had been avoided for so long. Yet, from Washington to Wall Street, warnings of these risks seem to be met with collective indifference. The confidence that the U.S. economy remains unassailable is unwavering, even as cracks in the foundation become increasingly evident. The emergence of DeepSeek, a revolutionary AI system developed by a relatively obscure Chinese research firm, underscores a broader reality that the technological gap between the U.S. and its rivals is not as wide as assumed. Innovations outside Silicon Valley are rapidly catching up, challenging the long-standing dominance of American tech firms. The geopolitical implications of such developments should not be ignored, as they reinforce the necessity for strategic recalibrations in trade and industrial policy. Trump's renewed aggression on trade may stem from a recognition that the U.S. economy cannot withstand another prolonged tariff war. His rhetoric, while combative, may be a strategic ploy to force rapid concessions rather than engage in drawn-out conflicts. If he succeeds, he will be celebrated as an unorthodox leader who strengthened the nation's economic standing through calculated brinkmanship. But if he fails, he will be remembered as the president who ignored every warning sign, triggering an avoidable crisis through reckless trade maneuvers. The world stands at an inflection point, and the actions taken in the coming months will determine whether the current economic expansion continues or if the long-anticipated reckoning finally arrives. Thank you for your attention, and I welcome your thoughts and questions on this complex and vital subject. Do you want to watch more videos like this one? If yes, please like and share the video and subscribe to get exclusive videos about how phenomenally China is developing and growing its influence. Your subscriptions and likes motivate us to generate more content, so Please keep supporting us. Check out this video showing on your screen right now, and I will see you on the other side.